Welcome to Inside Economics. I'm Mark Sandy, the chief economist of Moody's Analytics, and I am joined by a bevy of my colleagues today. We've got Ryan Sweet. Ryan is the director of real-time economics. You know what bevy means, right, Ryan?
No, I have no idea. I'm going to have to Google that.
Right.
Is that like a flock of birds? It's like a flock of birds or something?
Flock of birds, right. I don't know if I'm using the word correctly. Well, we got Cris who's the deputy chief economist.
He definitely knows.
He's got to know. Cris,
Yeah.
do you know? Is bevy the right word? A bevy?
I think so. It's a group, right? A large
It's a group.
number.
It's a group. A big, reasonably good sized number. And of course, rounding out the group is Dante DeAntonio. Dante is a regular here on Jobs Friday, and of course today is the day that the December employment data got released by the Bureau of Labor Statistics. So welcome, Dante.
Thanks, Mark.
Now, Dante, did you know what bevy meant? Is that like in your lexicon?
That's in my repertoire, yeah, bevy.
It's in your repertoire. Okay. I think lexicon is the more appropriate word, don't you think?
Probably.
Yeah, probably. Yeah. Okay. Well, it's
So
good,
we're
good
going
to
to
have
talk.
everybody.
We're going to talk vocabulary instead of the.
Yeah, let's forget about employment. Yeah, I'd rather.
Yeah.
ADP.
I am.
Let's go SAT words.
We should point that out. Dante joins us when he's wrong.
Yeah.
Yeah.
Not just wrong, very wrong.
Like really
we can
wrong.
just move on from that discussion entirely. Something else you want to talk about there?
You want to? We'll come back and explain that. But Dante.
Well, since we're on SAT words, my favorite SAT word, which describes how I feel right now, is apoplectic.
Apoplectic. That, in my thinking, means like a chaotic, confusion, upset, bad. Yeah. Okay. Yeah. Those are all good words.
Angry.
Angry. Yeah. Okay. Because you were wrong too. We were all wrong.
We were all wrong.
The most wrong. Yeah, I was probably the most wrong. And of course, we're talking about the December job number, which it came in 199,000 jobs create. Couldn't they have just made it an even 200K? Why 199?
Well, why?
Please.
I mean, they're wrong. So
it's wrong. Yeah, you're right.
The number's wrong.
It's wrong anyway. But it came in at 199. Okay, so let's do this. I'm going to turn to Ryan, have him summarize the report, and then ask for commentary on that. Then we'll do the game, our game, the statistics game, and I'll explain what that is for folks who don't know. Although I believe this is our 39th podcast, guys.
Wow.
And so if you don't know what the game is, then you've been asleep. You haven't been following. And then we'll talk about some labor market issues because obviously it's Jobs Friday, and there's a lot to talk about there on the jobs front. On the labor market front. There always is. Okay, does that sound like a good roadmap for the conversation?
Mm-hmm.
Yep.
Right. Okay, so Ryan, just give us the numbers, give us a sense of things. How would you explain this report to folks?
But I don't want to give too many numbers because I don't want to take somebody's number for the game. But the key numbers are, again, I think the way to describe this employment report is a tale of two surveys, just like last month. Household survey, much stronger than the establishment survey. So that 199,000 number that you threw out there, that's the net increase in employment. That comes from the establishment survey. Job growth was pretty disappointing. The consensus was for over 400,000. Dante's number was north of 800. So,
and explain that. When you say that, what do you mean? His number?
8. I was gonna give him a break.
You're gonna rub it in at some other point.
Yeah, later.
Okay.
Yeah.
All right. So, later we'll rub it in. Okay, go ahead.
But if you look at the household survey, which again, roughly 60,000 households are surveyed about employment, the unemployment rate came down from 4.2% to 3.9%. Prime age employment to population ratio ticked up from 78.8% to 79%. So we're getting closer and closer to that 80% threshold that's consistent with an economy at full employment. So again, wage growth picked up, labor supply issues are binding. All in all, I think, it was a strong report. Even that 199,000, it's very, very misleading. If you look at non-seasonally adjusted employment, which, removes any seasonal adjustment factor, it actually increased in December, which is very, very rare. So I don't know what the BLS is doing with their seasonal adjustment factors, but it's all very, very quirky.
Oh, that's interesting. So what you're saying is the data, the 199 is based on seasonally adjusted data. Obviously, you got to account for normal seasonal patterns, holidays, and so forth
Correct.
and so on. And typically, you see a decline in December employment, non-seasonally adjusted.
And it
This
increased
month,
this
we actually
December.
saw an increase.
hmm
Despite that, the seasonally adjusted number was small. Increase was small, 199.
Yep. So they doubled down on the seasonal adjustment factor. So if they used a normal seasonal adjustment factor, which was typical pre-pandemic, the increase in employment would have been closer to 500,000
Oh,
seasonally adjusted. So
what was expected and close
yeah,
to the
I don't
average
know.
monthly job
Maybe
gain.
Dante can explain what they're doing, but I have no idea what's going on with this process.
Okay, so you said two things. One, bottom line, don't pay attention to the 199,000 job gain. That belies the strength of the labor market. Everything else says strong job market. Second thing you said is the one way of seeing that is look at the employment gain that is from the household survey. The 199 is from a survey of businesses, establishments. That's what we typically look at. But you also have the household survey, which is the basis for the unemployment rate. That increased, I think, 650K, didn't it, or something
Correct.
like that? You know, something which would, again, feels more like reality than the 199K.
Right.
Okay. The one thing you didn't mention, which I thought you were going to mention, is revisions to previous months. Did you want to talk about that at all, or maybe I should let Dante fill in the blanks there?
Yeah, let Dante go.
Okay. All right, Dante.
Yeah, I mean, I was actually surprised that the revision to November wasn't bigger. You know, it was a positive revision, but it was pretty small. We got a decent sized revision in October, something around 100,000. But the revision to November, the response rate was historically low last month for the first print. So I was expecting a bigger boost given how low the number was and how big the difference was between the two surveys last month. And, you know, we didn't see it yet. It doesn't mean that we couldn't still get a big revision next month for November. You know, obviously we got a big one for the 2 months ago estimate now for October. So it could still get revised higher, but I was surprised that didn't move further this month.
Yeah.
Yeah,
Go ahead, Ryan.
On the revision front, if you look at the QCEW data, so that's the quarterly census employment and wages. That's right, Dante, right? Did I get that right?
Yep.
So we have that through mid-year. This is like a complete count. This is, you know, what's going to get benchmarked. We're going to get big upper revisions to employment.
Right. So just to make that more concrete, the establishment survey is a survey of a lot of establishments, but not the universe of businesses out there. Once a year, the Bureau of Labor Statistics says, hey, let's go and what they say call benchmark the survey-based estimates, like the one we got today, the 199, to actual employment counts, full employment counts based on the QCEW. That's the unemployment insurance record. So every company, no matter how big you are, you have to report to unemployment insurance, how many employees you have, for obvious reasons. And so you have a complete count, but they don't use that every month because it's just too many data points. They can't process it. So they do the survey, but once a year they come back and benchmark, and that data comes out, that benchmark data comes out next month, right? And you're saying that that's going to show a big upward, even a further upward revision in the data. And how do you know that, Ryan? Because you're looking at the QCEW quarterly data that's coming out?
Yeah, we bank it. So you can look at it.
Yeah.
Yep. So we can look at it. I can send you the chart afterwards. Through mid-year, we're going to get a big upper revision.
I think one thing to remember, though, is the benchmark that comes out next month is only actually through the first quarter of last year. So
yeah, correct.
That there wasn't much of a change through the first quarter. I think it's really going to take another year until you're going to see that big upper revision
shows up
in mid-2021.
Well, this just goes to highlight that, the difficulty of coming to some assessment of reality, right? Because it's going to be 2 years before we get all the data in for what happened in this period. But it feels like all the data, everything's getting revised up, right? Every month we're seeing these huge upward revisions in the data, and everything suggests that we created a boatload of jobs. Right? Said that again, boatload of jobs, but boatload of jobs. This is Andyism, a boatload of jobs in 2021, but it's even more than that. It's going to be even more than that when all the data are in.
Yeah, that's why Cris and I emphasize looking at the non-seasonally adjusted data, because the seasonal factors, just because of the pandemic, have been really thrown off. So looking at it, a little bit differently is more important.
Yeah. Okay. Hey, Dante, you heard Ryan's kind of summary of the report. And you kind of filled in a couple of the blanks. Any other blanks you want to fill in? Any other things you observed in the report that you think are important?
No, I think at a high level, the story is largely the same as last month. Like Ryan pointed out, it's seasonal adjustment, and it's the difference between the two surveys that sort of remains to be the big thing to try to figure out.
Yeah. Okay. I mean, all the other stuff was pretty solid. I think I saw average weekly hours was up. I think it ticked higher. And I think that's obviously a positive sign. Businesses can hire more people or they can increase the hours worked of people. What else? We mentioned the unemployment rate falling below 4%, 3.9%. And that happened despite, I think, stable labor force participation. Isn't that right? I think participation held steady.
Ignore that number.
Yeah.
What's that?
I was just saying ignore labor force participation.
No, I know.
I know you like to look at it.
No, but the unemployment rate didn't fall because labor force contracted or was
Right. No, the labor force rose. Yep.
Yeah, the labor force
Yep.
increased typically, so it wasn't that wasn't the reason why we saw unemployment decline. What else? Any other? There are some signs of weakness in the report. Abstracting from the technical measurement issues like seasonal adjustment, but I mean retail is soft, but there's got to be some fundamental reasons for soft retailing employment, right? I mean, there's some. Retail was weak before the pandemic because of increased online use. So that's a continued downward weight. And places like motor vehicle. I think we saw some job losses at motor vehicle dealerships, didn't we? And that obviously is because they can't sell cars because they can't produce them. Healthcare was weak. Nursing homes, that's been perennially weak, I think, for lots of reasons. And that may also be burnout by healthcare workers. They're just, clearly struggling with the pandemic. Very, very difficult time.
Chris, did you look at daycares?
I was down.
No, I didn't check it out.
It was
I think
down.
it was
Yeah.
down. I think
That's something
it
that-
was down in daycare.
Yeah, that's a problem.
Yeah, particularly for you,
Continues
right?
to.
I mean, yeah,
Okay, Dante, Chris, and I, we're
yeah.
daycare is important.
Struggling with that. Yeah.
Plus snow day today.
Yeah.
Yeah, we got a snow day. You guys got a snow day today, huh?
Second one this week.
Really? When,
Got a
wh-
COVID shutdown instead for 10 days. So just started today.
Oh yeah, poor Dante.
Oh boy, what a mess. All right. Okay, Chris, anything you want to add on the
You see,
job
Mark didn't
numbers?
offer to, help out,
Come
watch the kids. Yeah, yeah.
Are you kidding me? You really want me to watch your kids?
Hey, at this point, it's been a long 2 years.
Yeah.
You'll take it. You'll take it. Well, I'll be teaching them SAT words. So yeah, that'd probably
That's
be
fine.
pretty good.
That's
That
fine.
all works out.
Chris, anything in the job numbers you want to point out?
I look at some of the demographics just because that's also part of the Fed mandate. So a couple of things that stood out to me were education. If you break out the unemployment rate by education, so the biggest gains or improvement in unemployment rate was at the lower end, so less than high school or high school graduates saw the biggest improvement. So that's encouraging. On the other hand, if you look at the numbers by race, most of the improvement was really driven by white demographic. African Americans actually saw their unemployment rates rise in December, so that's troubling. And then if you dig a little bit further, you see it's actually African American women who's had a big jump from November to December. So I don't know exactly what's going on there. Maybe we talk about the pandemic in December not having a large impact on the labor force overall, but maybe it did impact certain occupations or industries where African American women tend to be more concentrated. So that certainly stood out. That was a pretty sizable jump in an unemployment rate for them.
Yeah. Of course, that again, when you get down to those,
Yeah,
that level of
there's some
detail,
volatility. Yeah,
based
sure.
on the small sample, and the seasonal
Yep.
adjustment issues, hard to
Yeah, I don't want to.
moved in the wrong direction, but hard to draw too much from that. Yeah.
Yeah,
Okay.
but certainly something to bear in mind if the Fed is keeping those demographic trends in mind as part of their policy decision.
Yeah.
Certainly something to watch.
Right. Okay, two questions then. One is, well, obviously this is backward looking, this report, right? This was based on a survey that was done about a month ago, not quite a month ago, but before Omicron. This was kind of on the backside of the Delta wave. So that's one reason why we all expected a pretty solid job number for December, and why we expected a strong job report, which we got. But then there's Omicron, and that is now in full force. In fact, it feels like when the Bureau of Labor Statistics does its survey for January, which is next week, that could coincide with the peak in infections. They're pretty close.
Yeah.
And so, what do you think about that? So, what do you think of what that means for the employment report for the month of January, which we'll be talking about 4 weeks from now?
Means we're going to add 1 million jobs because everything is backwards.
It's backwards.
Everything's backwards.
It's just going to be
Up
the
is down.
seasonals unwind.
Yeah,
Seasonals
exactly.
Unwind. Oh, geez.
No, I think it's possible that employment falls. We saw that, when Delta peaked, employment fell in December of last year. So, this
I don't think
wave,
that was Delta though.
That wasn't
not the
Delta, yeah.
That was.
It wasn't?
That was a previous variant. I can't remember
Oh,
which
okay.
variant that was. Delta hit it this past summer. A year
oh yeah,
ago, though, December.
I can't keep these things straight.
I know it fell, but it was a different. That was a pretty
Different
bad
reason, yeah.
wave.
Might have
it was
been
a
beta.
different variant. Beta probably.
I don't know.
Yeah, but job growth did slow during Delta. You can see it very clear that it took, a bite out of the job market. So I think employment could fall.
Yeah, I meant to ask you, Ryan, because you look at the number of people that aren't working.
Wow, that was my
because
number.
there's-
I got to come up with a
Oh.
new number. It's
Oh
all right.
no. Okay. sorry about
1.6
that.
million, up from
1.6 million?
1.5 million. Yep.
Up from 1.5.
So if you look at the
Okay.
relationship between average confirmed COVID cases during the reference week versus the number of people that are not at work because of own illness, the relationship's pretty strong. If that holds, we could be over 2 million next month or for January.
Yeah. Right. Okay. Okay. So it's pretty clear that Omicron's going to do some damage here.
Yeah,
probably
I think so.
in January. Anyone have a different perspective on that? I mean, obviously a lot of measurement issues, and all joking aside, you may be right.
Mhm.
The seasonals, if they were wrong on one side, in December, they got to be wrong on the other side at some point, right? So it could be month of January. Okay.
I'd agree with that, but I guess one other factor, for better or worse, is that the isolation period now has been cut down to 5 days, right? So
Good point.
whereas Delta was 10 days, so the volume is still well above what it was. So I think it will have an impact, certainly, but it might not be on a relative basis as big as we might otherwise expect.
Yeah, and that goes to kind of a underlying assumption we've been making all along here since the pandemic hit, is that we are going to experience more waves of the pandemic in all likelihood, but that each wave of the pandemic will be less disruptive than the previous wave. That Omicron is going to do damage, but less damage than Delta, and Delta did less damage than, let's say, Beta back a year ago, and so forth and so on. And so far, that feels roughly right. That feels like that's roughly right. We're getting better in terms of how we respond from a healthcare perspective. Of course, the virus itself is helping, right? It's becoming less virulent, and that's a positive thing. And businesses seem to be getting better at kind of figuring this out and adjusting to it, so it's less disruptive, but still disruptive. It's still kind of, the pandemic is still kind of driving the train here, but increasingly less so. Okay. I said I had two questions. The first was around Omicron. The second is how do you? And I'll turn to Ryan for this. Ryan, how do you think the Fed members view all of this report? How does this fit in with the way they're thinking about things?
It has no bearing on monetary policy. They're gung-ho focused. They're laser focused on inflation. They are, even the most dovish members of the FOMC are turning hawkish. So yesterday, Mary Daly, who's the president of the San Francisco Fed, as recently as November, was pushing against any rate hikes this year, is now on board with, she said that inflation's too high. So they're really worried about inflation being higher for longer. You can see it in the FOMC minutes. They're talking about, reducing the size of their balance sheet very quickly after the first rate hike. So, this is like I think I emailed Cris, like it's like the Fast and the Furious. The Fed is going to aggressively tighten monetary policy because they're petrified of inflation.
Well, from that prism, though, this report has bearing, right? I mean, if you're
I think the
FOMC
wage
members-
number, even though I don't look at average hourly earnings, I think the Fed, they're paying very close attention to measures of wages because they're worried about a wage price spiral setting in. There's no evidence of it yet, but the job market is getting tight. They're going to get worried that strong inflation or strong wage pressures are going to pull up inflation even further.
Yeah, right. And of course, the 3.9% unemployment rate also, right?
Mhm.
I mean, as you point out, that and the employment to population ratio for prime age workers, they're not quite where you would expect them to be in a full employment economy, but they're getting there.
We're getting
pretty
there.
fast.
Mm-hmm.
So, I would think they're looking at that and saying, oh, we need to normalize policy here, get going here and try to normalize policy.
Yeah, so financial markets put an 85% probability of a rate hike in March.
Oh, is that right?
Mhm.
85%. So
Yep.
March is the month when their quantitative easing will come to an end. Their bond buying will come to an end.
Correct. The tapering
March.
process ends in March. Yep.
And they're saying they're going to start tightening interest rates right away.
Mhm.
As soon as the QE, the quantitative easing is over, they're going to start raising rates.
Yep, that's what the bond market's saying.
Mark says. I did notice, I looked at before we got on the podcast, the 10-year treasury yield actually, even with that 199K number, which is on the soft side, 10-year yields are rising. They still rose. So
Mhm.
they're it feels like investors are interpreting the employment report the same way we are. It's a strong report. The 199, yeah, okay. Right, okay, very good. Okay, anything else?
Like,
on
do you
the
disagree?
employment?
Like, what do you think the Fed's going to do? When do you think they're going to raise interest rates?
Well, I think it's more likely going to be June when they raise rates for the first time. The reason being that I think Omicron's going to do some damage here. I think
Yeah,
it's
I
gonna
agree.
hurt growth.
Mhm.
And you're going to see it in January. You'll probably see it in February going into March. And so, unemployment could be back over 4, maybe as you go into March. So if that forecast is right, if I'm right about Omicron doing some damage here, and we have that in our forecast, right? We, before Omicron, we had GDP growth for the first quarter close to 5% annualized. We marked that down to 2, which is very consistent with what Delta did to the economy back in the third quarter. So we're using that as a case study here for Omicron's impact. So if you get 2% growth in Q1, you will still get solid job growth. I think coming by March, April, the job market will rev back up. But I don't think that'll be enough at that point for them to start raising rates. I also expect inflation to come in. That by the March, April period, it'll be clear that, inflation has rolled over. Energy prices are down, gas prices are down. We should see some abating of the shortages and high prices for some of the for various goods, and we'll see inflation roll over. So the combination of those two things would, I think, suggest that the Fed might want to wait a little bit. But having said all of that, I don't think I'd argue the point very strongly. I mean, it's possible it could be March. I wouldn't attach an 80% probability to it. I might attach a 30% probability to it, but I'm not going to argue with anybody about it. Rates are going up. There's no doubt about it. It's just a question of, precisely when and by how much. So,
right.
From my perspective. Cris, anything on that you want to add? Do you have any different
I'd agree
perspective?
with you.
You agree? Dante,
Yeah.
anything? No? Okay. You're on board with that. All right, let's play the game. Oh, well, okay, before I do that, just to make sure. Is this about the time where we tease Dante or
No, we can do it. Yeah, this is a good time.
Okay, go. Okay, so what's going on here? Dante is the key guy that puts the ADP data together. ADP is the human resource company. They have records for 20, 25 million employees. We get them, then we use that to construct an estimate of what we think the employment gain will be. We're predicting the BLS number a couple days before BLS comes out. So we put out the ADP number on Wednesday. Today's Friday. We said employment was going to be up 800. Was it going to be 800K? I think. Yeah, 800K private sector jobs.
I think it was
And
807. 807.
Thanks, Ron.
807K. And
807.
Dante, it came in at 199. And there are months when, they're pretty close, but it seems like every time we have Dante on, it's really badly wrong. Is that just do I have that wrong? I think that's right.
No, that's right. Yeah,
That's
It's
wrong.
almost
Correlation.
always bad, yeah.
Yeah. Yeah. So we have you on. So we know when we have you on, your ADP is going to miss pretty badly.
That is true.
Yeah.
And I would like to remind people that you ultimately approve that number before it gets covered. So I like to make sure.
Thanks
I
very
place
much.
That,
Thanks
place
very
that blame
much.
when it goes. Yeah.
I usually remind people of that when we're right. Just saying. Yeah. Right.
I mean, to Dante's credit,
Yeah.
or to back him up, everything else was consistent with a very strong employment
I
number.
know.
I mean, this is like,
Yeah.
this is a fluke.
Well, and actually, I think ADP has been consistently stronger than BLS first print I think all year long. And again, every month the BLS number gets revised higher and then revised higher. And we just argued it's going to be revised higher again. So by the time it's all said and done, it feels like BLS is going to be closer to ADP than the other way around.
I don't know about that's a big gap to close in December.
Oh, is that right? Okay.
Yeah,
Yeah.
600,000 gap.
Yeah, 600,000.
That's a big gap.
I don't know. Did they ever go back and adjust the BLS? Ever go back and adjust the seasonals? Did they ever do that? I guess they do that when they get.
As part of the benchmarking process,
part of
they
the
do
benchmark.
update the seasonal
Hey,
factors.
I don't know, Ryan. It's possible.
Yeah, maybe.
Yeah, that seasonal feels really weird.
I mean,
really
again, if they used a seasonal factor that was, that they used pre-pandemic, so like the average of 2018, 2019, the increase in employment in December would have been closer to 500.
Yeah, right. And again, that's the average monthly job growth, roughly average monthly job growth in 2021. I think it was closer to 550 all together. Yeah. So, okay. All right, let's play the game. Who wants to go first? Should we let Dante go first after we give him such grief? Okay.
Yeah, there you go.
That's fine. Ryan walked the tightrope of giving this away, but I'm gonna use it anyway because I think it makes sense. It's important.
Should I explain the game? The game is, each of us give a statistic or two. The other of us try to determine that statistic. I was going to use the word guess, but
There's no guessing.
No guessing.
Deductive reasoning.
And the best statistics are one that first it's something that came out in the previous week, this past week. It's not too easy that we get it right away, but not too hard that it's too elusive and we all look stupid. So those are the best statistics. And it's related to it's bonus. It's related to the topic at hand, which is in this case the job market. So, but that those are just guidelines. That they're you can do what you want, which we all do. But all right, and if you get it right, we do have a cowbell somewhere. Although
It's right back there.
It's right back there. Don't get it out. It's okay. We'll keep it there. Okay, Dante, what's your statistic?
That's a lot of rules. No pressure to thread that needle of hitting all those guidelines. that you played out. Mine is 72,000.
72,000. Right away. Right?
Was that the increase in?
Ryan was
non-seasonally-
walking. You never actually said it, but yeah, you were walking the tightrope there early on.
Is that the increase in non-seasonally adjusted employment?
Yeah.
Yeah.
And so this, you mentioned it's been a while. That's the first time it's increased in December since 1999.
There you go.
Oh, wow.
I mean, that's
What
pretty
was the
telling.
seasonally? What was the okay? So listener, 72K is the increase in employment in December payroll survey, establishment survey, non-seasonally adjusted. Remember, seasonally adjusted is 199. This is unadjusted 72K, and you're saying that is the first positive, not seasonally adjusted increase in establishment payroll survey since 1999. That's what you're saying.
Correct.
It usually in December falls by a couple 100,000.
Yeah.
So,
and
I mean, this is a stark difference.
right. And the difference between the two, right, was the 199 and 72 is 127,000. That's by far the smallest difference between the two over that same 20-year period.
Mhm.
The average difference between the unadjusted and the seasonally adjusted is about 325,000. So usually in December, the seasonal adjustment process adds about 325 This month it only added 127 for some reason.
And that's
know,
why I
okay.
say this is a strong number. I mean, the takeaway is it's a strong number. Anytime employment increases unadjusted, non-seasonally adjusted in December, it's a strong number. It's a strong month.
Hey, Dante, do you know offhand what was the seasonally adjusted increase in December employment, 1999? How big an increase was it?
I do not know offhand.
Yeah, maybe look it up real fast. Yeah, I know you're online. Yeah, I'm just really curious what that number was. Yeah. Okay. So Ryan, what's going on here? Is it just the pandemic is scrambling the BLS seasonals? I mean, what I don't understand. What's going on?
I don't know. I can't
You don't
explain
know?
it. I don't know. And that's why anytime I do the forecast, when I write it up for our website, I always highlight that the seasonal adjustment factor is a big wild card. Like it can make the number really, really strong, or in the last few months, it's made it very, very weak.
I guess we can go dig deeper and go sector by sector, industry by industry,
Correct.
and see if something stands out.
hmm
But again, could it be more fundamental? That go back to retail. I mean, the thought was that people started buying early for Christmas because there were shortages and prices were up. They were fearful of not getting the presents they wanted under the tree in time. So that could have juiced things up, earlier in, like, say, October, and that steals away from the kind of numbers you would expect in December. Is that so? That would be more fundamental, right? I guess. Could it be?
Yeah, I think that was the case. I mean, you saw
Okay.
retail employment increase in October and November. But November, I mean, we had an early, this is why I'm scratching my head a little bit, is that we had a very early reference period in November. So I thought more of the holiday hiring would be captured in December.
Yeah.
But it's possible maybe, people are shopping more online. Some of those jobs ended up in transportation, warehousing, couriers, rather than in your traditional retail employment.
And I've said this once before, but let me ask it again just to make sure. If the seasonals are pushing things down in a month like December, it stands to reason there's going to be a month or two or something coming up where the seasonals are going to work in the opposite direction, right? That they're going to juice.
Correct.
We're going to think a weak number, and that's what you were joking about January. We
Mhm.
think a weak number, but we could get a big number because the seasonals work in the opposite direction.
Yeah, throughout the year, the seasonals have to wash out.
Right.
So
All right. What was it in 1999? December 1999? What was the gain?
So the unadjusted gain in 1999 was 137,000. That was the last time it was positive in December.
And what about adjusted? What was it?
The difference actually wasn't that big then. The adjusted was 306.
306. Okay.
So that was actually a pretty small difference between the two compared to the last 20 years.
Yeah, right. Okay. All right. Very good. Okay, that was a good one. Might have been a little easy.
It was a
Dante,
softball.
just
Yeah, I
saying,
helped
just
Ryan
saying.
out.
Yeah. Okay. Okay, Cris, what's your statistic? And
All right.
is it housing, Cris?
yeah, it's definitely housing.
It's 181,000.
All right, so it's definitely labor market related.
It is labor market related.
All right, you hesitated.
Yes.
He always hesitates. He
Yeah.
he
I'm
tries
just,
to do these head fakes to make it more difficult for us. Yeah.
It's on
I'm
to
not
me.
sure if that's right.
It's got my tell.
Yeah. Can I ask this? Does it come from
Yes.
the household survey?
No.
It comes from the payroll survey.
No.
By definition. Oh.
Hmm.
Ooh.
There
Yeah,
was
that's-
another survey
it's
that
a
came out
JOLTS
this
number.
week.
Does it come from the JOLTS survey?
Ding, ding, ding. Yes.
Ding, ding. JOLTS being job opening labor turnover survey.
Turnover,
So that's
yep.
where the quits
That's
come
right.
from. Hiring comes from. That's where open job positions come from. 181. Dante, you should know this.
Mm-hmm.
Too many days ago now.
The JOLTS for November came out, I think, on Wednesday. I think it came out on Wednesday.
Tuesday or Wednesday.
And that
Oh,
showed
yeah.
quits were at a record high, I think, right? 6 million, 5 million people quit their job in the month of November. Record number of quits, which we'll come back to.
Is that the increase in the number of quits? 181,000.
That would be really, you know.
Oh, the 181? No.
Yeah,
no,
that would violate. That's too hard kind of rule.
Oh,
That's a
well,
second
maybe I vi-
derivative. Give me the second
I
derivative.
might have
of it.
violated that rule.
I was gonna say, I feel like we're going down that road here.
It is
It's
housing related.
probably-
Housing
Oh.
related.
Oh,
How about
Construction quits,
it's construction layoffs?
layoff. What the,
181,000.
Ooh.
Yeah.
really?
Yes.
what's that about?
Construction. 181. So it was up in November versus October. October was 132,000. So
No, wait.
uh,
You're saying 181,000 construction workers got laid off in the month of November?
yes,
Oh, and that's up from 132 in the month of October.
October. Yeah.
And is
And
181 high by historical standards?
Not by how we were
okay.
at that level earlier in the year, but things had been trending down because construction activity was picking up. But now they reversed, and I attribute that to some ongoing supply chain issue. Lumber, especially, has become dear again. So I think there's a slowdown in construction once again due to that, and they're laying off because they don't have the materials to actually build the homes or
Oh, boy, that
construction.
you that's interesting. That's a long chain of events. Do you buy
Well,
into
otherwise
that? Dante, do you buy into that
Well,
explanation?
first of
for
all,
me?
if I would have studied the JOLTS release for an hour, I don't think I would have known that
No.
number anyways. That was pretty
Mhm.
deep in the weeds. But, I think I can buy Chris's story there. I mean, the logic makes some sense.
Hold on,
Why
wait,
else would it
wait.
jump up, right?
Right. I mean,
Well, that's why I asked, is that typical? I mean, that was seasonally just, obviously. That's
Yeah.
right. Yeah.
Mhm.
So I don't know. Just, I don't know. That feels weird. Why would you're saying, so what you're saying is that supply chain disruptions causing problems with lumber, appliances, building materials
Yep.
means that home builders can't put up homes. Therefore, they're going to lay off other workers that they otherwise would have employed. That's what you're saying.
Yes.
Ooh,
right. If
what
you
do
can't get
think?
materials, you pause. You press pause on building. for
I
a
don't
while.
know. I mean, if you look at housing starts, they're still really strong. I mean, Katie and I are trying to find an electrician to do some, and our normal electricians like, I'll get to you in like 3 months because I don't have enough people to cover all the jobs. So, I don't know. That sounds a little.
That was actual layoffs though, Cris, right? You said layoffs in construction. Layoffs, okay. Not you could separate because of it's not separations, is it?
Oh, it's layoffs.
It's
Layoffs.
layoffs. Okay, all right. I don't know. That feels
I-
bogus to me.
Yeah,
I don't know.
I'm
just
with you
saying.
on this one,
All
Mark.
right.
All right. All right.
We'll see. We'll
all
see.
right.
But
Okay,
lumber is
well,
way up, right? Lumber prices have skyrocketed again. There's a
Mhm.
shortage
I thought
once
that was
again.
mostly tariffs, though, right? I
No,
thought.
that's climate. It's
Oh, okay.
you have
I thought we.
disruptions in Canada,
Mhm.
right? So we can't actually get the lumber out.
I thought lumber prices peaked back in May, I believe, at what $1,600 a board square foot.
I think that's
Got
about
down
right.
to $600K, which is kind of more typical back a couple months ago or 3 months ago. Now we're back up to $1,200, I believe, something like that.
That's right.
And I thought a big part of that 600 a few months ago to 1,200 now was the tariffs. But you're saying no, that may be part of it, but it's also
I don't think that's a major.
the major factor.
reason,
You
right?
actually think
We're
because of
talking doubling,
weather
right?
in British
Yeah.
Columbia, they couldn't get the lumber out, and so therefore it's disrupting the ability to put up homes, and therefore
That's right.
we're seeing some layoffs in the construction trade. Geez, I don't know. Okay, all right, we'll dig deeper into that one. All right. Only an economist, and really a good economist, could come up with that chain of events.
Mhm. He had to
Alright.
tie it back
All
to
right,
housing somehow.
provocative. At
Yeah,
least.
provocative.
Provocative.
Definitely provocative. Yeah, definitely
All right.
provocative. Yeah, okay.
And housing related, Ryan. So I didn't disappoint.
I know. That was impressive.
key. Yeah. Oh, yeah, I thought he was going to give us the core logic house price index again.
Mhm.
Up 18, 20%, something like that. Okay, Ryan, you're up. What's
All
your
right.
statistic?
So this is the Holy Trinity. Covers all three. All right, you ready?
Oh, now I'm scared, actually.
Yeah.
3%.
What is
3%.
3%.
3%.
3%. And when you say the Holy Trinity, does that 3% apply to three different things? That 3%?
No, it covers, it's related to the job market. It
Okay.
is related to the big topic, and it came out this week.
Oh,
Oh.
I see. I see.
Oh,
You nailed
okay.
it.
Oh, yeah.
You're saying.
You got all
Yeah,
the criteria.
You nailed it. You
Yeah.
nailed
Mhm.
All right.
it.
Unlike Dante, I can
Okay.
come through.
All right. Well, let's dig a little deeper. 3%. Does that come from the household survey?
It does not.
Does it come from the payroll survey?
It does not.
Does it come from JOLTS?
It does.
Okay.
And
Everyone
you guys
knows.
should you and Chris should definitely get this. I sent you a chart of it this week. I sent you a lot of
Oh, it's
charts.
a
but
quit rate. It's the quit
Yeah.
rate.
Quits.
Yeah, it's the quit rate. It's the quit rate. Yeah.
Yep. Highest
Okay.
on record, going back to the early 2000s. And that chart I sent you, it shows you the quits rate versus year-over-year growth in the employment cost index for wages, which suggests that we're going to get another very strong increase in wages in the fourth quarter. And
the
that,
quit rate. Oh, sorry.
go ahead. I was just going
No, I was
to say
just gonna-
one reason why the Fed pivoted. Powell was very concerned about very strong wage growth that you saw in the ECI, the employment cost index. So this is going to spook them again, and this is why I think they're turning more and more hawkish. Is that they're really concerned that wage growth is going to start pulling up inflation.
Right. And the quit rate is simply the number of people who quit their jobs divided by the labor force. So we had 4.5 million, 4.6 million people who actually quit their job in the month of month of November,
Mhm.
record high. You divide that by the labor force, you get to 3%. That is a record high. And this data goes back to, I think it goes back to the year 2000.
Early 2000s.
Yeah, early 2000s. And you're saying that is indicative of an incredibly tight labor market. You know, when you have high quits, a lot of turnover, tight labor market, businesses want to retain their workers, they jack up wages. Wage growth is rising has accelerated. Employment cost index, probably the best measure of wages.
The best, yep.
The best. Let me ask you this though. I keep going back on wages to the Atlanta Federal Reserve Wage Tracker,
Yeah.
which also I find equally as good as the ECI.
Yeah, that's very good.
Because it tracks the same workers,
Mhm.
right, over time. So it doesn't have these mix effects like you would have like looking at average hourly earnings, the wage measure from the employment report. And that shows an acceleration, but it's all in low wage jobs. You know,
That's where the quits are. So if you look at the
That's where
quits
the
rate
quits are.
for leisure and hospitality, it's gone through the roof.
so but it's not broad based. I mean, I look at
No.
you know, if I look at wage growth for high wage workers, that's actually decelerated. Mid wage workers, it's flat to maybe up a little bit. It's accelerated a little bit, but it's
Mhm.
all in the bottom quartile of the wage distribution, right?
But isn't that where we have the labor supply constraints are the most binding right now, are in restaurants, in travel, leisure.
Yeah, yeah,
Yeah.
that's right. But then I try to connect that back to monetary policy. So okay, if it how worried should I really be that this becomes more broad-based, endemic, leads to higher inflation? If it's just it's idiosyncratic to the pandemic,
Mhm.
labor supply issues for this one segment of the the labor market, the low wage jobs. Should I be yeah, I mean
They shouldn't be
get it.
concerned.
I shouldn't. Yeah.
No, they shouldn't be, but they
Oh.
are.
Oh,
So it's like
okay.
kind of like going back to like how we forecast monetary policy. We got to forecast what they're going to do, not what they should do. Like,
Yeah.
I don't think they should be panicking right now.
Yeah. Okay. That's okay. I get you. But Powell did call out the acceleration in the
Mhm.
employment cost index as a reason for why he pivoted. I guess he
Yep.
needed a reason. He's got to give some reason why he pivoted.
Yeah,
why-
exactly.
Right. So he's got to come up with something. You asked me the question, when do I think the Fed would have
Hike.
its first rate hike? The market says March. I said June. What do you say?
This pains me, but I agree with you. It's going to be
Oh,
June.
really? Okay,
Mhm.
June. Okay.
Why is that so painful, Ryan?
Yeah.
Because
well,
Mark and I
that
usually
was
never
mine.
agree on monetary policy. So the fact that we agree is,
Well, our debates are pretty on the margin.
oh yeah,
aren't
yeah.
they,
No, we're
Ryan?
not like,
Yeah.
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 No, it's,
pretty,
but it's
pretty
fun.
Close. Yeah.
Yeah, I enjoy you, Chris, and I going back and forth about this.
Yeah.
Chris, when do you think? He's going to say June because
He's gonna say May because that's between March and
yes,
June.
exactly. He
Yeah,
goes,
exactly. Oh, God.
Man.
do that. He's
Got a
going to say,
reputation,
he
Chris,
was going to
for
say May. He was
going
going
down
to
the
say
middle.
May.
That was a March, not a May. Yeah, I actually
Oh,
think.
it was- oh, okay.
I
Oh,
think
you think March? You think
I'm
you're going
getting
to March?
more and more
Yeah.
convinced that they're gonna follow the
Yeah.
market here.
Hmm.
They're gonna
Okay.
deliver.
They're going to, yeah, you may be right. The growth really will have to slow because of Omicron to delay for them to pause. Yeah.
I think so.
Hey,
Yeah, that's true.
Dante, do you have a view here on the first rate hike?
Yeah, I think I would lean probably towards Chris. It seems like they might. It seems like sort of it's all shifting in that earlier direction towards March. It feels like that's what they want to do, unless there's something that comes out that seriously changes the story between now and then. That's probably what they're going to do.
Yeah. Okay. Yeah.
On wages, did you see the wage growth for economists?
Is there such a thing?
No, I'm just giving you a heads up. It's really it's a tight labor market
Where
out
do you
there,
get
Mark.
that data?
Yeah.
Wage growth for economists.
We do our own survey.
Yeah, we do our own survey.
Oh, is that right?
Up 10% this year. That's the
Yep.
benchmark you're looking at. Yeah, 10%.
Hold on,
increase.
wait. You guys are making something. You're making this up. Where you
Yeah,
getting
if you want a
this
time
data?
series, Dante and I
Is
can
that
create you a
seasonally
time series.
adjusted or?
Yeah.
Unadjusted and season adjusted, both 10%.
So you are making this up.
Yeah, we're making this up.
Okay. Geez, it went right over my head. You guys are too
Mhm.
good. Too good. Yeah. All right.
So what's your number, Mark?
Okay. This runs a risk of being too easy, and I may have to ask Ryan to recuse himself.
All right.
With this, which gives you a hint, by the way. 8.7 trillion. 8.7 trillion. Ryan, do you know?
I'm thinking. No, I don't know off the top of my head.
Oh, okay.
Wait,
Like
did this
it's
come
gotta
out this
be
week?
Fed related if Ryan's excluding
Yeah.
himself.
Oh, no.
I mean,
Oh,
I'm
okay.
stretching. What's that, Dante?
Oh, I wait. No, I'll
This
let
week.
Chris and Dante.
I don't know what it is, but I feel like it's got to be Fed related if Ryan was excluding himself from the conversation.
Oh, damn! I shouldn't have said anything. I actually
Yeah.
helped you out by saying that, which is true. It is Fed related, and that
It's a balance sheet.
related.
Related.
Yeah, very good. And so, what is it? If it's balance sheet related, 8.7 trillion. No. All right. Ryan, go ahead. Do you know the answer? He's looking it up.
No.
You are looking
No,
it
actually,
up.
no. My wife she got pulled over because I forgot to update the registration, so she's not happy with me right now.
Oh boy.
You need to go take care of that.
Wow.
No.
Okay.
What am I gonna do?
Yeah.
Isn't it the assets held outright?
Yeah,
2.7?
that's the size of their balance sheet, the size of the Treasuries MBS that they hold on their balance sheet. 8.7. I picked that because we had the FOMC meeting, right? On was it minutes from the FOMC meeting got released on Wednesday, and that was pretty hawkish. And 8.7 trillion is that's up a lot. If you go back. Before the pandemic, we were closer to 4 trillion. So that's an increase of about $5 trillion. And just for context, if you go back before the financial crisis, it was 1 trillion. So went from 1 to 4. Now we're 4 to 8.7. And by the time the QE ends, we're probably going to be pretty close to 9 trillion. Not quite, but pretty close to 9 trillion. And then it's the Fed saying, hey, I think, correct me if I'm wrong, but I think the Fed's saying we're going to now relatively quickly let that wind down. I mean, we're going to stop buying. We're buying now. We're tapering those purchases. At the current rate of tapering, our purchases will be over by March. Market says in March they're going to start raising rates, and we've been debating that. But then the next question is, what happens to their balance sheet? If you go back to after the financial crisis, once they stopped tapering QE, they kept the balance sheet pretty stable. They started, when a treasury matured or a mortgage security matured or prepaid, they would take the proceeds and they would reinvest so they'd keep the balance sheet stable. So the question is here, what are they going to do? Are they going to allow the maturing treasuries and MBS, the prepaying MBS, to start to allow the balance sheet to come down? And I think the general sense is, correct me if I'm wrong, is that they're going to allow that to happen. They're going to allow the balance sheet to start winding down pretty quickly here. Again, going back to the point that they're going to normalize policy pretty fast here. Is that right? Do I have that right?
That's correct. Yep.
And that's called quantitative tightening, right? Or the QT. So we're going from QE, quantitative easing, bond buying, to quantitative tightening, QT.
Correct.
They got that right. Okay. And
Yep. And they're going to go. They're going to be
Pretty
aggressive.
slow, though.
what's
They're
that,
going to be
Chris?
aggressive.
I mean, if they're just letting it run off, it's going to be pretty slow, because I would think, because of the mortgage, right? The prepayments are going to be way down with rates rising. But
I think they've got a lot of debt maturing. A lot of
They do.
those treasuries are going to mature pretty. I think
okay, on the
60,
treasury
70 billion
side.
a month
Yep.
mature, right? Something like that
I think Chris is right on the MBS side.
on the
I think
MBS side.
that's going to be slow, but you're right that they have a ton of treasuries that are maturing. So they're going to use caps. They're going to limit the amount that the treasuries can decline, but their caps are going to be larger than they were after the financial crisis, just because of the sheer amount that they have maturing.
Yeah. Okay. But we don't think they're going to outright sell.
No.
That would be kind of panic mode if they were selling.
Mm-hmm.
Yeah. And I guess one reason why the 10-year treasury yield, the bond market is sold off, why treasury yields have risen so much, is because it's dawning on investors that the Fed's going to go from buying bonds, and they've been buying a lot of them during the pandemic, to actually allowing their balance sheet to come off. And that's a big change.
Mm-hmm.
Yeah. Okay. All right. So what do you think? That was a pretty good statistic, I thought. No?
That was a good one.
Yeah, it was pretty good. Yeah, pretty good.
Not necessarily tied to the labor market, but it's all right.
Yes, sort of indirect.
Yeah.
Yeah, you're right. Yeah, but I thought we needed to mix it up a little bit.
Yeah, no, it was a good one.
Yeah. Okay. All right. I need a little stroking. Yeah. So, okay. Where are we? Okay. Let's now turn to the labor market in more detail, and a bunch of different questions we could try to tackle. But let's tackle the quit rate, the 3% quit rate, the 4.5 million, 6 million that quit during the month of November. Dante, what's going on? Why such a high quit rate?
You've got historically high job openings. You've got wages that are rising at levels that we haven't seen in a long time. And there's just a lot more opportunities out there for people. And I think, in addition to that, you've got lots of people who are looking to change their current work situation, looking for more flexible arrangements, or remote work, or whatever the case may be. So I think the abundance of possibilities, and people as a result of the pandemic looking to make changes in their current work situation, I think are all contributing to the number of quits we're seeing. And I don't expect that to decline anytime soon. I think if anything, you're going to see that sort of continue at least through the end of the year and early next year, because wages are going to continue to rise. Job openings haven't really ticked down much to this point, so there's still those opportunities out there.
So there's there's a long list of reasons, and you put forward two, and I assume these are at the top of your list. The first is, well, we got a lot of open job positions. So pandemic hit, a lot of lost jobs. We got the vaccines, the economy reopened. Every business on the planet seemingly put up a help wanted sign at the same time. So if you have all these open positions, then people feel comfortable about, quitting and trying to find a better job, because they know that they could get one pretty fast if they needed to get a job. That's at the top of the list.
Yep.
Okay. And then the second reason on the list is, I'm putting my own spin on it, remote work, right? That is, people, and I use that as a euphemism for, I want workplace flexibility. I want more flexibility in my work arrangement, the hours I work, where I work, how I work. And if you, Mr. Employer, Miss Employer, don't provide me with that flexibility, well, I'm going to go find another job that does. Do I have that right?
Yeah.
Okay. All right. Okay, guys, any other reasons you would put on that list? I mean, first of all, are those the top two reasons you think for the high quit rate? And would you put any other on there?
I think so. I think there's very active recruiting going on as well. So, folks who aren't even considering looking for a job may be getting calls. That might be leading to some of this impact as well. I also wonder about self-employment, people starting up their own jobs as well, or their own businesses as well, and if that's feeding into this higher quit rate at this time. So
Right. Ryan, any other
No,
reasons?
that was a good one, Chris. I didn't think about
Which,
the people starting their own companies.
business,
Yeah.
yeah.
Entrepreneurship has picked up.
Picked up a lot. You know,
Mhm.
if you believe the data from the IRS on EIN numbers, business starts.
Yeah, I think lower on the list would be people quitting because of the pandemic. In restaurants, with each wave, people are they're worried about getting COVID or bringing it home. So that could be a smaller factor.
Why would you put? I would have put that pretty high on the list. I mean, particularly because we're seeing the quits in those industries that are on the front
Mhm.
lines of the pandemic, and when the waves come through and people get sick, they quit.
Yeah, that's good.
Yeah. So I would have thought, actually, I'd have put that probably at the top of the list or pretty close to the top of the list.
Yeah, I wonder if it's just more labor market churn in the sense that people that are in restaurants, bartenders, waiters, maybe they're just fed up and they want to change industries.
Yeah.
Could
Right.
be.
Could
What
be.
about boomer retirements?
Yeah,
You
I was
you
going to
think
say
that's
that
gonna
too.
is that gonna change? Are they quitting now but coming back in later, or is this a one-way street here?
Well, I think
You
it
think?
partly depends on those housing values and those stock prices, right? I mean, people have been, I think the boomers feel pretty comfortable about leaving maybe a little earlier than they would have otherwise. They were going to leave anyway in the next few years, right? Because the
Yeah.
teeth of the baby boom generation is in the early 60s now. I think it's 62, 63. So they were going to leave anyway, but they're leaving a little earlier, in part because they got shoved out by the pandemic and they're not coming back in because they don't need to, right? They've got pretty sizable nest egg with stock prices, housing values, all the excess saving that built up during the pandemic. So I don't know. Do you think they'll come? I guess it's possible, right? You retire, you kind of try to figure out retirement. You go, hey, this isn't really working for me, or at least, or if my retirement nest egg is diminished because prices come back down again, they can cut back in. But I would think that's on the margin, though, don't you think?
Mm-hmm.
I think
Yeah.
some of the flexibility that's popping up,
Yeah, good point.
that could bring some people back part-time or contract. So on the margins,
Yeah.
it could help. But I think you're right. By and large, they're out, right? They're not coming back in any appreciable numbers, and that's going to weigh on this market then for a while.
Yeah. Right. Okay. Here's the other question. So there are a long list of reasons. They all feel kind of pandemic related. And as the pandemic winds down, these things will start to normalize and recede. And in fact, I guess what one could argue, if people are finding better jobs that are more suited to their needs, that turnover might be even lower than it otherwise would have been a couple, 3-4 years down the road, right? I mean, that might be, you might see less turnover, possibly. No.
Moving forward, you mean if people are finding better matches today?
Yeah, on the
You may
other
get
side of
less
the
turnover.
pandemic.
Yeah.
Which
Especially
means
with
some of
the work from home. If you
Yeah,
find a job,
exactly.
you could get less turnover down the road. I agree.
which gets to the question, and this is always a hard question for me to answer: is this a good thing or a bad thing? You know what I'm saying? Is the high quit rate a good thing? Is this a positive development, or is this a? I mean, obviously, there's transition costs for the businesses that are struggling filling positions for people that are quitting. That's no fun. We know that. We're hiring aggressively, and trying to add to payrolls at the same time as hold on to retain existing workers. That's a lot of energy. That's a lot of work. But is it a problem longer run? Any views on that, Dante? Do you have any sense of that?
I mean, I'd find it hard to believe that it's not a good thing for workers. I mean, it seems like workers feel empowered one way or the other, and that's reflected in that higher quits number. I mean, yeah, I think you could make the case that for businesses, it's probably a net negative. I mean, there might be some benefit if you get workers who aren't the best fit leaving, who maybe would have just stuck around before because they didn't have any other options. So maybe you get some benefit from better fit with workers, but I don't know that I think it's probably outweighed by the the costs associated with recruiting and with turnover and all of that. So I have to imagine it's probably a little bit of a negative to businesses.
Yeah, although again, it depends, right? It depends on your horizon. Maybe on the other side of the pandemic, they have a more stable job base than they have now. The other thing is businesses are not standing still; they're responding, presumably, right? They're investing, I would think. I mean, we can see it in the data. The investment data has been pretty strong. Some of that goes to supply chain restructuring, but some of that goes to, I think, labor-saving technology. Businesses realize that this is going to be a problem long run, tight labor market and high wages. And I need to figure out how to do things more productively, which would be a good thing, would be a positive thing. I don't know, Cris or Ryan, do you have a different? So Dante says good for workers, not so good for business. What do you think? Good or bad?
I think in that.
Or is that the wrong question? Am I asking the wrong question?
No, I think it's a good
It's a
question.
good question.
Yeah.
Yeah.
I'd say good, and certainly from a macro perspective overall, right? There are certainly some businesses that are going to struggle more than others, but in the end, I think it'll push them in a direction where they increase productivity or they accommodate their labor force better. They make changes. So I think it's a positive. I think a wild card here though is immigration, and what the longer term prospects are for the labor market are going to depend heavily on what that immigration policy looks like.
I think it's good for. I think it's good for businesses in the sense that the pool of available workers, is much larger now. Think about what we're doing. 10 years ago, would we have considered, hiring an economist and, having them stay in California? Probably not.
Yeah, exactly.
Now, the doors are wide open. So.
Right. Yeah. It's actually hard to kind of disentangle all the cross currents here, in terms of what it means. Yeah.
The question I have is, do you think this ever fully reverts back to what it was do you think job openings ever get back to where they were pre-pandemic, or do they stay elevated? Do quits ever go back to sort of the old level, or does churn stay higher than it was before?
The opposite of what I was saying on the churns. It stays elevated because you're saying the remote work. You're saying people can move around a lot more easily. Therefore,
Well, that, and are you in a perpetual state of a higher degree of labor shortage? You've got more openings all the time than you had before, and so you've got more opportunities for workers all the time, and they're sort of constantly looking and evaluating more than they used to. I don't know.
Right, you're saying for other reasons the labor market's going to be tight, demographics,
right,
aging out of the boomers,
right,
weak immigration, so you have an inherently tight labor market. Therefore, that's going to keep quits up because people have opportunity to quit. Yeah.
Possibly. I mean, right, we've seen lots of job gains, but job openings are still, they've barely budged, right? They're down slightly off of their 11 million high, but they've barely moved, even though we've added workers pretty consistently here. So
yeah, interesting. So it's just the opposite of what I was saying, that after the pandemic we get a more stable workforce, fewer quits. It could be, who knows? It could be hard to know that. Very interesting point. Okay.
If we're moving to a national labor market, I think it's going to take a while for things to equilibrate here, right? We're just at the early stages, right? Everyone's grappling with what it means. What does pay mean? Do you regionally adjust? Do you not? I think there are a lot of open questions here in terms of where the equilibrium actually is. It could be, could have a lot of churn for a while, I guess is what I'm saying.
There's a lot of open questions about what remote work actually looks like in the future, right? I mean, do firms settle on mostly hybrid models where they aren't hiring nationally because they still want people to come into an office periodically, or do more of them end up in a sort of fully remote world where they don't care if people ever come to an office? I think that's still to be decided in large part for a lot of companies. So
you're right. A lot of good. A lot of cross currents there. Hard to know how that's gonna play out. Okay. Well, I think we've got time for one more kind of broad labor market issue before we call it a podcast. What should we tackle here? I mean, I guess wage growth might be one place to explore a little bit in more detail, because that is key. What's your sense? Do you think wage wage growth is going to roll over here, that is going to normalize, that, going back to low wage workers, that's where the wage growth has accelerated the most significantly. Does that come back in or we're going to see the wage acceleration broaden out more deeply across the labor market? What do you think?
I certainly don't think it comes back in
Mhm.
soon. I think we're still probably accelerating or plateaued maybe, but I certainly don't think it's going to start to decelerate in the near future.
Yeah.
It seems like there's pressure on both sides, right? Firms are offering higher wages to retain current workers. Firms are offering even higher wages to try to lure workers to them. We see that we don't talk about it a lot, but the ADP wage data, the pay increases for job switchers have still been ticking higher and higher, right? Firms are offering bigger and bigger increases to workers over the last 6 months to lure them away. And I don't, with the number of job openings that still exist, I don't see that changing anytime soon.
Right. So your sense is that this acceleration in wage growth is going to continue and broaden out to other parts of the labor market.
Yeah, I don't know that it'll fully broaden across all income skill groups, or whether it's sort of the lower end of the distribution is enough to sort of sustain it for some period of time. But it certainly doesn't feel like it's going away in early part of this year for sure.
Well, I suppose as the economy comes into full employment, that means higher wage growth, right? I mean, a broadening in the wage growth. All goes back to the Federal Reserve. Good reason for it to be starting to tighten monetary policy or normalizing policy as quickly as possible. Yeah. Okay. Any other thoughts on that? On the wage picture? No. Okay.
I think short term, Dante's right, but I always come back to automation and productivity enhancement. I think those investments are going in now.
Yeah.
They will bend the curve later on, right? Maybe later this year, maybe next year, but I think employers are sensitive and looking for other ways to supplement or to substitute for labor.
Mhm.
Yeah, I mean, our baseline forecast, kind of in the middle of the distribution of possible outcomes, are pretty sanguine. Right? We're saying that as the pandemic winds down and recedes, and that's kind of the working assumption that we're operating under, that each new wave of the pandemic is less disruptive than the previous wave, and over time, this kind of recedes. If pandemic becomes more endemic, that labor markets are going to start to normalize, get back to they're not going back to where they were pre-pandemic, but they are going to get back to something more resembling what we're used to. Wage growth for low wage workers will moderate, and those for other workers will remain roughly where they are today, consistent with productivity growth. We see some improvement in productivity gains as businesses respond to the tight labor market and the realization that they're going to be dealing with persistent labor shortages for a long time to come, and the higher wages gives them an economic incentive to do it. And the combination of all that, and of course the Federal Reserve will normalize monetary policy, raise interest rates in a way that causes growth to ultimately slow, so that when the economy achieves full employment, which is, if everything sticks to script, about this time next year, about a year from now, that the economy kind of soft lands. Everything kind of glides down, comes down on the tarmac, and life is good. We're all good. That's the baseline, and that's the strong consensus view, right? That's the view. But it feels like, based on this conversation, it's going to be pretty bumpy. Landing that economic plane on the tarmac isn't going to be quite as graceful as I just described it. It's going to be difficult. Did I get that? Is that a fair characterization of kind of the way? That's how I'm thinking about things. Is that you guys are on board with that?
Yeah.
Okay.
Yeah, this is a more boom bust cycle.
Well, that's a little different. Are you saying we're booming and we're gonna bust, or are you saying it's just a little more boomy, busty, a little more bumpy there? But
Yeah, it's more bumpy. Yeah. Yep.
Yeah.
Turbulent. So we'll stick with the plane metaphor.
I don't know. I'm coming to the conclusion. It's not a conclusion. It's not the right word. I need a better word. But it's starting to bother me that the plane is coming into the tarmac at a pretty high rate of speed. You got a lot of winds blowing in lots of directions, pandemic waves, fiscal policy, and the fog of bad data. We don't know really, what's going on exactly. Are they going to actually be able to land that plane on the tarmac? And by the way, historically, they rarely do.
Yeah.
Never done it before.
They never do. So I guess what I'm saying is I'd start watching out for 2023 and 2024. This could be a little more difficult. We'll have to watch and see.
It's one of those plane landings where it's really bumpy that people start clapping that we actually made it on the ground.
Yes,
Have you ever been on?
exactly.
Yeah, it's gonna be one of those.
Yay! And everyone's clapping as you. Yeah, right.
I never understood that when people clap when we land. It's like isn't the expectation that you land? Like, I don't know.
I think it is. It's like
You don't applaud for meeting expectations. That you're,
Yep.
It is relief. Yeah, I'm alive. Thank God. Is that right? Okay, I think that's the metaphor we're going to use. Okay. Well, I think this was a very useful podcast. We covered a lot of ground. Any
You're forgetting
last
something,
words,
Mark.
guys?
You're
Pardon me?
forgetting something.
Yeah, at Mark Zander.
There it is. There it is.
I wasn't going to say anything until you said something.
No.
I'm on Twitter. So is Ryan, but he won't tell us what his handle is.
Next week, I'll tell you.
What is it?
I'll tell you next week.
Okay, tell me next week. At Mark Zandy. And please feel free to follow. And anything else, guys, before we call it a podcast? No good? Hey, thanks, Dante. Always appreciate it. And
anytime.
Good-natured. I know we make we have a lot of fun, but
Sure.
it's all good-natured. You're great. Okay, thanks everyone. See ya. Talk to you next week. Take care now. Bye-bye.